5 years ago, your client purchased at par 100,000 of New Brunswick City Go general obligation bonds maturing in 20 years from now and callable in 6 months. Interest rates have gone down over the last 5 years. Which of these should your client do? 5 years ago, client purchased at par 100,000. What's par value for bonds? Par value for bonds is 1,000. Maturing in 20 years. Callable in 6 months. Which of these should your client do? Your client should recognize that the bonds have a high probability of being called, and your client should expect the bonds are trading at a small premium. So you want to remember, when it comes to rates, with rates down, when rates are down, bond prices are up. Rates down, bond prices up. Think of interest rates and bond prices on a seesaw. So when interest rates go down, older bond prices go up, therefore trading at a premium. So when interest rates drop, the issuer, which is New Brunswick City, wants to refinance their debt at a cheaper rate. So they will call. Call option means they will buy back the expensive older bonds as soon as they can. Market risk and interest rate risk are examples of market risk and interest rate risks are examples of systematic risk. So you want to think of systematic as in system-wide, meaning this risk inherent to the entire market system. This risk is inherent to the entire market system. It cannot be avoided by diversification because it affects all stocks or all bonds. Systematic risk infects the entire system, such as market risk and interest rate risk. All investors and investments are different. Recognizing this, it is true that. So when it comes to recognizing that all investors and investments are different, there's no one size fit all. Recognizing this, it is true that no investment should be deemed suitable for every investor. So you want to think financial customization. There is no such thing as a one size fits all. Like I said, when it comes to investment products, there's no one size fits all. And when it comes to regulatory rules, compliance auditors view any system claiming a product is perfect for everyone as an automatic red flag. So every individual client possesses an entirely unique profile of income, age, risk tolerance, and time horizon. If somebody tries to sell you a product claiming that it's perfect for everyone, once again, auditors view that as an automatic red flag. A change to tax rates on dividends would be an example of a change to tax rates on dividends would be an example of legislative risk. When it comes to legislative, you want to think laws. Legislative risk. Legislative equals lawmakers. So whenever a risk is caused by Congress, a government, or an elected body changing a law or a tax code, it is legislative risk. So, you want to remember legislation equals legal changes, like tax codes and laws. New Haven Farms is a producer of specialty foods. They recently received a notice that the Wetlands Maintenance and Drainage Act passed indicates that a significant portion of their current land used in food production falls under the Act's protection and may no longer be used for agriculture. This is an example of, this question is mentioning Act's protections no longer being used. When it comes to passing acts, you want to think laws. So, legislative risk. You would think, once again, acts passed is legislative. So, whenever a problem is caused by a new statute, law, or piece of legislation passed by a governing body, once again, it is legislative risk. So a key clue would be look for the word act. Which of the following risks is not a non-systematic risk? In other words, it's asking you which of these is a systematic risk and not a non-systematic risk. And the only one on here that would be a systematic risk is interest rate risk. Like we talked about before, market risk and interest rate risks affect the entire system. So it's systematic. Those other three answers are examples of non-systematic. The risk when investing, where one has the potential to lose all or part of the investment due to circumstances that are unrelated to the issuer's financial strength or well-being, is known as the risk when investing, where one has the potential to lose all or part of their investments and it has nothing to do with the company, is known as capital risk. You would think capital is your core money. So capital risk is the raw danger of losing the principal cash you originally put into an investment. So you just want to think, wrong place, wrong time. This risk has nothing to do with the company going bankrupt or managing its business poorly. It simply means the market value of the asset fell before you paid for it. It simply means the market value of the asset fell below what you paid for it. The ability to take the proceeds from the redemption of one security or investment and allocate those proceeds in such a way so as to maintain the same level of return is expressed in which of the following concepts? Ability to take proceeds from redemption, allocate those proceeds in such a way to maintain the same level of return would be reinvestment risk. With reinvestment risk, you want to think proceeds, reinvesting. Whenever a question talks about taking the cash proceeds from a bond that just matured or was called and trying to find a new place to put it, you are looking at reinvestment risk. All investors and investments are different. Recognizing this, it is true that when it comes to recognizing that all investors and investments are different, the one statement that is true is that no investment should be deemed suitable for every investor. You remember, suitability is individual. So FINRA suitability rules require every investment recommendation to be tailored to the specific client's profile, such as their objectives, their risk tolerance, and financial situation. It's per individual. There's no one size fits all. Because every investor has unique goals and constraints, no single investment vehicle can be universally appropriate or suitable for every single person. Risk with a business that represents a specific threat to that company is an example of which of the following? A risk within the business that represents a specific threat to that company specifically is an example of which of the following? You'd want to go with non-systematic risk. Because it's not affecting the entire system, it's only threatening that one company. It's a non-systematic risk rather than a systematic risk. Because it's only affecting or a threat to that company, not the overall markets. The ratings on the debt instruments of a foreign country with outstanding loans from a number of other countries worldwide have been downgraded. The impacts felt due to the risk of possible default is known as So when it comes to ratings on the debt instruments of a foreign country and other countries worldwide, other countries worldwide, you'd want to go with sovereign risk. Sovereign risk is a specific risk that foreign government will default on its commercial debt obligations or bonds. A rating downgrade on a country's debt instruments directly signals heightened sovereign risk. Which of the following is a unique risk incurred by investors in mutual funds that specialize in holding securities in the fund portfolio from foreign issuers? A unique risk incurred by investors holding securities in the fund portfolio from foreign issuers. From foreign issuers, securities holdings would be currency risk. So currency risk, also known as exchange rate risk, is the risk unique to investments in foreign issuers. So foreign issuers could be a keyword, susceptible to currency risk. When a mutual fund holds international securities, its returns can be negatively impacted if the value of the foreign currency falls relative to the US dollar. An investor who relies heavily on fixed interest payments from long-term 25 to 30-year bonds should be most concerned with an investor who's heavily fixed on interest payments from long-term bonds should be most concerned with, when it comes to long-term bonds, should be most concerned with inflation risk. With inflation risk, any long-term fixed income investors are highly vulnerable to purchasing power risk. Over a 25 to 30-year period, rising consumer prices will drastically erode the purchasing power of fixed interest payments. Which of the following would be most susceptible to currency risk? As we mentioned before, when you think currency risk, you can always relate it to foreign investments. You can have some currency risk. So the best answer to go with would be common stock of a large, well-established company in England. With currency risk, once again, this risk applies explicitly to investments tied to foreign currencies. So because an England-based company operates and is denominated in British pounds, a US investor faces exchange rate risk when converting those returns back into US dollars. And that currency risk with foreign investing, foreign securities. And which type of investments are most susceptible to interest rate risk? Which of these investment types is most susceptible to interest rate risk? You remember, like inflation risk or interest rate risk, they can hurt fixed income securities, especially any fixed income securities that are long term. So out of these answers, the most susceptible to interest rate risk will be bonds.